Welcome back. In this video, we are going to do a simple form of forecasting an income statement with just a few entries. Nothing to elaborate, but just to get started, getting used to on which ones can we do follow a certain trend or average, and which ones have to be done with the information provided. In this example, we have information for 2019 and 2020. Our goal is to project 2021. The approach we're going to do is based on sales. Now, we are going to give you the sales projection for 2021. On a different video, we will speak of how to project sales. But for now, we're going to focus on how to fill these out based on a certain level of sales that are expected. We do have some notes, the tax rate that would apply, and that this company will have an addition to plant and equipment, and the expected life is 10 years. This would affect depreciation. Okay, so let's start with cost of goods sold. On this one, we will base it on the relationship between cost of goods sold and sales. So one way to do it is to first see the percentage of sales belongs to cost of goods sold. So in Excel, to start a formula to calculate something, you start with an equal sign. That tells Excel that we're going to input a formula or a function. In this case, I'm going to select the cell cost of goods sold, and I want to divide it, that's the division sign in Excel, by the sales. Now what I'm going to do here is I'm going to make it a percentage with a couple of decimal spots. Now we want to do the same for 2019 because our goal is to use an average of those two. So I can retype the formula, or in Excel have a couple other options when I just need to move a formula from one place to another. I can simply copy. I can copy using the copy function here, or Control C, I'm sorry, Control C is copy. And then I can just paste it. And what it does here is that this one was using these two. Here, once I copied and pasted, it automatically moved it one cell over to use these two. Another way to do it is I can hover over this little square here. Once I have that crosshairs there, I can drag it, and it will do the same thing. It starts using the next one over. Okay, so, but I want an average of these two. Let's go ahead and write average here, so we know that's where we have it. So again, in Excel, we have certain functions. I can go here where it says auto sum, and I go to the drop down, and there's an option that says average. So you click on it, and it starts it for me. Notice up here says equals average. So the equal sign lets Excel know we're going to start a function. In this case, it's the average function. And it's going to guess to the best ability that you want to use these two because it's right next to it. But let's say it didn't. All you do is you just select them. And they'll show here G7, G7, and H7. And it's telling us that the average is 83.93. You can also see how the function and the formula show on this bar up here. Okay, so, and let me double click here, as you can see it on the video. All we do is equal average, open a parenthesis. We have the range of sales, G7, G7, and H7. And that is your average for those two. Now that we have the average, we're going to go ahead and use it to project the cost of goods sold of the next year, the year in question. So equal to start the formula. I'll take the sales and I'm going to multiply it. Asterisk is the symbol in Excel to multiply by that average. I'm just going to click on it. Now notice that cell is an I7, and that's why an I7 showed up here. Hit enter, and that is our projected cost of goods sold. Gross profit, the projection would be just the standard procedure, that equals sales minus the cost of goods sold. And that's that. Now for SG&A expenses, we are going to use the same process we used here. Now we can go ahead and punch in the equal sign the same way that that we did on the previous one, going equals this divided by sales, the SG&A divided by sales, and it gives us that percentage that we wanted. Now, you could do the copy and paste approach, but you always have to be careful because when it moves, it's going to move in more than one place, but you can adjust it. So I want to copy that and I want to paste it here. Now, the thing is that when I click on it, notice how it moved all of it down. But what you can do is, there's another way to do it. You can just move that one where it belongs and it will adjust here. And that gives us the actual average. Or you can do the same thing we did earlier. Just drag it that way and you still get the same number. Let me do that again. Now in this one, since we already have it and we want it to all of it move down there, we can copy. That was a right click. I can right click on the cell, copy, and right click again. And you have different paste options. Just do the first one in this case. And that is our average. And same thing, take the sales equals sales times the average. And there we go. That is our projected SG&A. Now, fixed expenses, because we do not have any notes saying of any changes, the fixed expenses are going to equal the same as the previous year in this case. Notice that the fixed expenses have not changed. And there is nothing saying that it will change. So we can either punch in the number or you can say equal to that one right there, the previous one. In this case, because no changes on fixed expenses are expected or noted. We'll get the same number. Now, depreciation doesn't change based on sales typically. Depreciation happens when you buy a building or equipment. So we have here in the notes is that they're going to have an addition, a net addition to plant and equipment. Maybe they bought some stuff and sold some stuff, but at the end of the day, the end result was an increase by 50. Now this is 1,000, so I'm assuming 50,000. They're telling us that the life expectancy of the equipment is 10 years. So we need to know the new depreciation, the added depreciation. So what's the additional depreciation and straight line? We're going to say straight line depreciation. We can do equals to start the formula. The 50 divided by the 10 years. And it's going to go up by 5. So here what we want to do is equal sign. The previous year depreciation was 20 plus the addition of the 5 that we just calculated because of the net addition, 25. Now let's say that the company sold more equipment and plant and building, etc. This number would have been negative and it would have reduced it instead of increasing it. But we have a positive addition. So now it's 25. So what's our earnings before interest and taxes? EBIT, also known as operating income. Start the formula, equals the gross profit minus the projected SG&A minus the fixed expenses minus the depreciation expense. And that is our projected EBIT. Now, interest expense. We have no notes stating that debt has changed or that they borrowed more or paid off debt. So because there's no information of any changes on debt, then it's safe to assume no changes on interest. So we're just going to equal it to the previous interest expense. That's all the information we have. That's all we can do. So now earnings before taxes, we take our EBIT minus the interest, and that's our earnings before taxes, also known as taxable income. So how much taxes do we have to pay on that? We're not going to do the percentage approach of sales because we do have the tax rate. So you take your earnings before taxes equals the taxable income times the tax rate. And that is the projected taxes to be paid on the next year. And net income, finally, earnings before taxes minus taxes, and that is your projected net income. So in recap, for some items, like cost of goods sold and SG&A, we used the average of the relationship between the item and sales. For these, you just subtract and add according to the income statement. And then things like depreciation, which is not a function of sales, it depends on plant and equipment, additions or subtractions, property, plant and equipment. And then interest expense will be something dependent on changes in debt, not sales. And taxes is just the tax rate. If you didn't have a tax rate, then you can use this approach for taxes. But because you do have a tax rate, then you use the one given. If not, yes, you could have used that approach. Just to take a look, if we were to do that. But that approach not based on sales, just based on earnings before taxes. You could have done this divided by this, which happens to be 25% anyways. Oops. And we could have dragged it like we normally do, and it was 25%. So it seems like 25% was steady, and it would have been like that. So it could be given to you, or you could have done this. If for any reason it's going to be 25% of both that. One of these were different, it could happen. Changes in tax laws or different net income levels. Then you could have used the average here. That's fine. Or you can use the highest one if it went up. Either way, the thing is that it was given a tax rate, you can use it. If it's not given, there are other ways to approach it. And you have to make some judgment calls sometimes. But for now, it was not necessary. It was given to us. And there we have it. A simple approach to forecasting an income statement. It can get more complicated as the income statement, as you may see, some of them are much longer with a lot more detail. And you have to pick and choose which ones you do by sales, how you adjust certain things. But this is the basic approach when using sales on some items and the rest depending what are there dependent of. Important thing to take away, things like this are related to sales and change according to sales. Things like depreciation and interest expense do not change based on sales. They change based on property, plant, and equipment and debt. We will stop this video here and see you in the next one.